Now that we've got our EBITDA, or earnings before interest, taxes, depreciation and amortization, what we want to do is figure out what our earnings is after interest, taxes, depreciation and amortization.
Okay, we're going to throw in our last couple of assumptions about like interest rate and capital expenditure in the assumptions chunk, and then we're going to do some crazy maths to make this all make sense in the other tab. Knowing how this stuff works, even though it's boring, is the difference between somebody who makes something nice and sells it and somebody who knows how to run a business.
You can think about startup expenses that you might have and ongoing expenses. Startup expenses might be lawyers' fees and accountants' fees for getting all the structures you need set up. You're going to need to incorporate your company. Let's add all the startup costs we've thought about. So we've got the cart, we've got the kitchen equipment, we've got the coffee machine. The coffee cart, we've got a quote for $15,000. The kitchen equipment, all the things we need, $2,000, and the coffee machine, $999. We got it on special. They're really just one-offs in year one. Interest is broken down into interest income that you might have. For example, if I've got cash sitting in the bank, that's paying interest, although in Australia at the moment we're not getting very much of it. That's interest income. You might not have any interest expense, but if you've borrowed money to set up your business or to run your business, or if you've leased equipment, you will have interest expense. So the interest line item can either be positive income, which can add to your bottom line profit, or it can be a negative expense at the end of the day.
Okay, let's talk about investment and interest. We're going to put two things in our assumption spreadsheet. Our equity investment is $20,000. And we're going to put an average interest rate on our cash in the bank of 2.5%. Okay, this maths gets super confusing. Stick with me. We're going to put our starting cash in the bank here. $20,000. Then our net interest expense, so that's the amount of money we start with minus our capital expenditure. Then we'll put that in brackets and times it by the interest rate, which gives us $950. A whole bunch of maths for a small number, but once the numbers get big, interest rates really matter. One annoying thing about interest is that banks are very good at making money, and the way that they do it is that if they lend you money, they lend it at a really high interest rate. If you give them your money and leave it in a bank account, they give you a very low interest rate back. So you might only make 2 or 3% on cash in the bank, whereas if you are borrowing money, you are going to have to pay the bank an interest that might be a lot higher than that. So if our net interest is negative, the percentage on that interest is probably going to be much higher.
Pretty easy. If you've got more income than expense, you've got something that adds to your profit. If you've got more expense than income, you've got something that detracts from your profit. So after interest, we need to figure out our depreciation and amortization. And this can be a little bit tricky. Depreciation refers to how I account for certain capital costs that are tangible in nature, like the camera used to film this video or the oven used to bake my muffins. And amortization refers to intangible assets like trademarks or intellectual property or goodwill. Chances are when you're starting out your business, you won't have any amortization to worry about. Depreciation is a non-cash expense that the ATO lets you count as an expense to lower your taxable income. Why depreciation expense is good is because it lowers your taxable income. So at the end of the day, I pay less tax. And for a business, obviously, the less tax you pay, the more profit that goes into your pocket. In my operating expenses, I know that oven is going to last me for 10 years. So I might depreciate that oven over a 10-year basis. So I can depreciate $100 each year over 10 years. But basically what depreciation is for all my capital items, what is the useful life, and therefore how much of it is going to be used up in each year. We figured out we're buying $18,000 of capital items in year one, and we should put together a simple depreciation schedule to help us figure out how much depreciation expense we've got each year. We know we've got the cart and we're pulling over the cost from the assumptions page. The cost of that cart is $15,000. The kitchen equipment is $2,000 and the coffee machine is just under $1,000. Now, the way to think about depreciation, as we've discussed before, is kind of what's the actual useful life of that asset and what's the value you're getting from that asset each year. So let's assume the cart will last us 10 years. Make that useful life $10. So what this formula is doing is it's taking the $15,000 and dividing by 10 years to get a depreciation expense item per annum. So that's $1,500 per annum. Kitchen equipment, let's assume that lasts 10 years as well. And the formula is in there for us as well, but it's the $2,000 divided by the 10 years. Let's assume the coffee machine's only going to last us 5 years. And so that's $200 a year over 5 years. Because we're only modeling for 3 years, all those figures are valid for over 3 years, so we can use that as annual line items. Now, effectively, what we've done down here in the model is just show the breakdown of depreciation expense. So the cart, we're depreciating $1,500 a year, and those assumptions have just been pulled from this annual amount. Again, kitchen equipment, $200 a year, and the coffee machine is only pulling for year 1 for some reason, but we need to do it for years 2 and 3. We start out with EBITDA. We've now figured out what our interest expense or income is. We've figured out what depreciation and amortization is. So we've got profit before tax. So your profit before tax is not quite what you take home at the end of the day because the ATO wants a piece of that.
Now, obviously, your mileage will differ, but let's just pretend we've got a 30% tax rate. The calculation in our cash flow tab will look like this. Our tax payable is just the net profit times the tax rate. Company tax rates are generally a single percentage that changes country to country. So it's like, I think it's 40% in America, 30% in Australia, and 0% in the Cayman Islands and other tax havens. Income tax, however, like personal income, is generally bracketed. So the more money you make, the more you are taxed. Let's say you're a single person business that makes $100,000 in a year. Should you have a $100,000 wage or $0 in wage and $100,000 in company income? In Australia, 30% tax on the company income would be $30,000. Whereas $100,000 taxed against personal income is like 25% in tax. So if we were to take the same amount of money and class it as company income or personal income, you get a different tax rate, which is a saving of about $5,000. What if you earn like $500,000 in 1 year? If that was taxed at the company tax rate of 30%, you would pay $150K in tax. However, if that $500,000 was a personal income, the tax rate gets really high and you'd actually pay like almost $200K in tax. So in that example, it's actually smarter to have a big chunk of that income as company tax, not personal tax. Now, a good accountant will help you manage that income between personal and company tax. And either way, paying tax is a really good thing because it means you're making bank.
So after you've figured out your tax, you deduct your tax from your profit before tax, and you get your net profit at the end of the day.
Which means that our net profit or loss is just our profit minus the tax we paid. And just like our other margins, we can express this as a percentage by dividing our net profit and loss after our tax against our total revenue.
It might be that your business doesn't make money for the first 3 years. If you're only looking at a 3-year time horizon, you might say that business doesn't make a lot of sense. But if you're looking at a much longer time horizon, if your revenue will increase exponentially relative to your costs going forward, then you might have a profitable business down the track. Now, your net profit is a little bit different from your cash flow because, as we've discussed, there are certain expenses that don't really represent cash out of your pocket for a particular period of time. Depreciation and amortization is your major non-cash expense. So to understand your cash flow, you need to add back the non-cash items that got you to the point.
Let me go through the last set of kind of confusing calculations about like cash in the bank and movements for the period and stuff. The easiest way to do this is just copy all the formulas from our template and then put your own numbers in the assumptions. Now that we've figured out our net profit and loss after tax, we can add back in the depreciation and amortization. We can deduct the capital expenses, which tells us after we have made money, paid all of our taxes, and taken away the amount of money we spent to start the business, we have the free cash flow to equity. That's kind of like once all the maths is done, we have the final number of making a loss or a profit for the entire year. Now we get to see how that compares to the starting cash we had in the bank, which in this example was $20,000, which means that our movements for the period, which is just a fancy way of saying like the sum total of the cash moving around for the year, equals starting cash in the bank minus movements for the period, which in our case is a $9,000 loss against a $20,000 cash injection equals an ending cash in the bank of $10,000. At this point, it's important to consider that different accountants will deal with this stuff in different ways. So if you showed this to one accountant, they might actually be like, this has been done wrong. You show it to another accountant, they'll be like, it's perfect, I love it. Money is weird and accounting for it is weird, and it gets really complex from this point onwards. But the important thing is that this is all of the important steps laid out one after the other. Okay, we've dealt with some of the annoying and confusing parts of this template. CapEx is the money that we put into the business to start it. Depreciation is like stuff becoming less valuable over time. Tax is all the money that we give to the government. Then we've got net profit, and the cash flow is the money that we actually get to take home and spend on stuff.
Well, this bit's important to understand to not only figure out your profit at the end of the day, but also your cash flow at the end of the day. And cash flow is critical. Often people say cash flow is king.
Especially when a business is just getting started, it's like really fragile. If you have that one customer pay you late and get a big tax bill and get like a bunch of super payments for your employees, you can suddenly need to pay $20,000 or $30,000. If you don't have that money in the bank, you're looking down the barrel at a $20,000 expense and you won't have any money to pay your employees. If you can't pay your employees, they don't stick around and you can't make the money to pay off that debt. This is what makes a business collapse.
If you run out of cash, you can't keep running your business. You'll go insolvent. So you need to make sure you've got enough cash to keep running the business, and you need to make sure that if there are periods in time when you have negative cash flow, that you've got sufficient cash to see you through those periods of time.